Hi, this is Curtis May, and welcome to this brief introduction to private family banking, the infinite banking concept. We also call it in our firm the private reserve strategy. Right. So, what is it? The private reserve or family banking is the goal of our firm. One, let's talk about what it is trying to do. You 35 cents of every dollar leaves most people's personal economy in the form of debt, right? So we are paying interest. What we do is try to help our clients by use of their own private family bank so that they can learn how to have money move toward them instead of away from them so that they can create generational wealth. So, in other words, you want to be a receiver of interest and not a payer of interest. Okay. And so think about what keeps you up at night. Okay. Is it profits of your business? Is it taxes? Or is it revenue? Is it growth of your business? Is the economy keep you up at night? Marketing for your business, your kids, retirement. Are you prepared? Investing, college, inflation, debt is a biggie, right? Healthcare. And so what happens is, what's the solution? Is the solution a better advisor? Maybe. Okay. A better plan, more money. And so, did you know that, most people think the key to growing their money is investing, is to find better investments that pay a higher rate of return. But at our firm, we take the opposite tack. See, there's actually more opportunity to minimize your losses than there is trying to pick the winners. So the focus is on efficiency of money. So you want to find money, and this is what we do, and this is what part of this strategy is about, is one, to find money you're losing unknowingly and unnecessarily, becoming more efficient, which improves your cash flow. And then now what we're going to talk about is, what do you do with that cash flow? So when we walk people through this strategy, we say, look, there's three parts of everything. So there's principles, right? So we do what we call principle-based planning. There's strategies. So what I'm going to show you is a strategy, but the principle is saving 15 to 20% of your income. That's the first of five principles of personal finance, which is a conversation for another video. But the strategy is being your own banker, and the tactic is using properly designed. I'm going to say four very important things, because you're going to hear it differently, and I'm going to show you how it really works. Is properly structured dividend paying whole life insurance, using it as a place to store cash. Okay. And so what happens is, see, one of the things, this is our Buckminster Fuller. He says, listen, I spent my whole life unlearning things that I found not to be true. And so the question that we ask people, if what you thought to be true turned out not to be true, when would be a good time to find out? So something I teach is called prosperity economics. We have the 12 principles of prosperity, but the first one is think, right? Think from a prosperous mindset. Scarcity thinking keeps you stuck. Thomas Edison said 5% of people think, 10% of people think they think, another 85% would rather die than think. And so ask yourself, are you living out of your imagination or out of memory? So if you're living out of memory, you're still stuck in the past sometimes. And the world is changing too fast to be stuck in the past. You have to adapt. So let's talk about, what is banking? What is this strategy? Okay. So private family banking is really simpler than you would think. Banking is just representative of storage, right? The creation and utilization of a pool of money or pool of capital that is controlled by a private individual. That's what private banking is, right? The one who puts the money in the bank, guess what? They own the bank. And so, which is a saving strategy, right? The one who owns the bank receives the profits from the bank. So this is not an investment strategy. This is about controlling the environment that you work in, okay? And so what happens is, see, banking is the most important business in the world. Every transaction requires money to flow from one party to another, right? And that money flows through somebody's bank, right? And the money must flow from a pool of money somewhere, right? There's only one pool of money. It's controlled by banks, insurance companies, or Wall Street. And so the question is, how much of that pool do you control? Okay. And so, and because what happens is banking is all about creating a pool of capital that can flow at cost to meet some need that you have, whether it's vacation, whether it's college, whether it's a car, whether it's down payment on an investment property, upgrade your computer system. If you can control that, you can, be in control of the game. So let's look at the players in the play. Shakespeare said all the world's a stage, right? But you got to know the players in the play. So in this play, there's three parts. There's a saver. And so we put money in the bank. And so where do we save cash? Where do most people store their cash? Savings, really money market accounts, savings accounts, CDs. But this is where they have a lot of their capital, qualified plans, IRAs, mutual funds, 401ks, and you're led to believe that those are savings vehicle, but they're not. You're really investing. Truth be told, give me another conversation. I'll tell you why it's not investing at all. You're speculating. So what happens is, but then you've got the bank, right? And so then you are putting your money here, and then you've got the borrower. And so what do? The money goes to the bank. The bank loans money back to people for credit cards at 18%, mortgages at 3-4%, student loans at 4 or 5%, business loans, auto loans. And so you got to ask yourself, are you the saver or are you the borrower? Well, most people are both actually at one time or the other, but we rent the banking function. We don't control it. Okay. And this is where the money's made. And so we're going to talk about how what if you could be all three? Wouldn't that be nice? And so let's talk about this. So how do banks make money? See, one, you got to understand what we're trying to do is mimic the business model of a bank. All the big buildings downtown are owned by banks. Okay. Banks and insurance companies, actually. And so what happens is, let's look at Bank of America. So we want to borrow their business model. So banks, let's go back to the players in the play. You got the saver, you got the banker, you got the borrower. Well, Bank of America, this is from the Bow Report 2017, had 909 billion with a B of deposits, and they paid $3.1 billion in interest to their depositors. Okay. So now what do they do? It might just sit there. No, it doesn't, as you know, right? They have borrowers. So now what do you have to do to borrow the money? Oh, they want to see your credit score, make sure you're worthy, that you got to pay the fees. You've got to have a job, because what they care about is, can you pay me back with interest? You got to apply. And so you have to jump through all those hoops because you rent the banking function. Meanwhile, they make $49.9 billion using whose money? Your money. See, so I grew up in the supermarket business. So my family used to go to it was cash and carry, or the supply store, to get cases to stock our store wholesale, and then we'd sell them retail, right? And so that's how money works. Got my, so because think about this, they're paying you basically 34 cents on every dollar, 34% interest, 0.34% interest, right? But they're making 5.5% interest. So if you could go and buy a can of peas for 34 cents and you could sell it for $5.50, that's a 1,600% spread, okay, or markup on money. That is one of the ways bank money. That's not the only way. I'm going to talk about velocity in a second. And so let's talk about, how do we buy stuff? So there's three types of people in the world. There's the debtor. So you see this, you go get money, you pay it back, you get some more money, you pay it back, you get some more, but you are always working your way up to, I call this the zero line, right? You're always working your way back to zero. When I work with people, most of the time I'm trying to get them to zero, right? And then you're taught, well, I got to get out of debt. So now you're saving, but for most people, saving is just delayed spending, all right? And you buy something, you take all your cash out the bank, now you're back at the zero line. So the result is still you're at zero. What if you could follow the blue line, put your money in a situation where you could always move that money forward and never go backwards? Every year you were guaranteed to, make more money you were doing the year before. That's family banking. That's putting your money somewhere where you now have momentum. So when you look at the savers, or what I call the accumulation theory, and then there's the wealth creators. So savers seek compound interest. Growth, where wealth creators seek velocity. We call this the velocity method versus the accumulation theory, right? Growth is taxable usually. You think that you've got to get you think it's all about rate of return, but the only way to get a better rate of return is to take more risk, and you're taught to equate high risk with high returns. Wealth creators seek guarantees. They want certainty. There's an economic value of certainty, right? They teach you in the accumulation theory to rent your insurance, buy term investor difference, where institutions and wealthy people buy whole life. They buy permanent life insurance. They buy cash value life insurance. Savers pay cash or use debt to buy what rich dads call doodads, cars and things that you pay for. And wealth creators use other people's money to buy good debt. What is good debt? Things that you don't have to pay back. You're using it to buy capital or cash flowing assets like real estate or business. Savers rent the banking function. They put their money in Wells or Citizens, and you're renting to banking function. You're giving it to them, and all the profits go to them. Whereas wealth creators own the banking function. That's what this little talk is about. Okay. Savers are taught to accumulate, and you'll never make money focusing on accumulation. It's just too slow. Whereas you've got to, again, seek velocity, and your dollars are just tools to fuel wealth creation, to fuel you buying more assets. Okay. So become a wealth creator. So here's how you're taught to think. Most people do this. They get money. You got taxes, because if you have a job, you get earned, you get taxed, you got overhead, you got your mortgage, you got car payments, you got your living expenses. And then if you're lucky, you say, well, I'll see if I can save some. See, folks, if you think that way, you're going to be poor. Okay. I don't even have any nice way to put that. And where you have to pay yourself first. So I don't have time to get into the nitty gritty of this. This is the tactic. So the tactic, or the product you buy, is properly structured dividend paying whole life to correctly use the strategy of family banking, right? Because you get a death benefit, you get cash value accumulation, and you use that cash to create wealth. So your life insurance cash values are your greatest source of collateral. So we call saving through life insurance building collateral capacity, meaning the money that you have saved that you can collateralize to use that money to buy other cash flowing assets or major capital expenses, yet keep your money always in play, always working for you, that you can own, right? And so who does this, right? So 3,800, US banks are the largest, hear me now, purchasers of dividend paying whole life. Starting with, if you see where it's circled there, JP Morgan, 12 billion. I'm not talking about death bill, I'm talking about the cash side, because they use that to store their cash. That makes up the better part of what banks call their tier one capital, which is money they don't loan out. And so who else does this? So you got Walt Disney, you got, these major brands you've heard of all do what I'm talking about. So if you've not heard of this, so consider yourself now informed, okay? Because it's not new, guys. It's just new to you. All right. And so Ben Brinkley stores his cash. He don't put money. He still does. He didn't put money in the stock market. His money is saved with insurance companies through various annuities. For example, for him, which is just a savings plan with an insurance company. John McCain used life insurance to fund his presidential campaign. FDR had $562 million of insurance, which is equivalent of $7 million a day. Walt Disney, when nobody would loan money for Disneyland, he borrowed $75,000. This is 1952, folks. $75,000 in his cash value of his whole life policy. Ray Kroc, the Kennedys, Jim Harbaugh, Brian Roberts, Jack Welch, Doris Christie. You heard of Pamper Chef. She borrowed like $4,000 against her insurance. Built it's like a Tupperware type company, and sold it to Warren Buffett for like $20 million. as a direct sales company. So that was a pretty good investment. Okay. And so what happens is this. Okay. So let's talk about, see, banking should be done at Nelson Nash used to say, banking should be done at the new you and me level. And he says that we've given the control of that money over to fools, he would say. And so banking is a process, not a product. And so money goes in to the policy, right? But once you have that pool of money, what can you do? I've had people buy cars and then pay back their collateral capacity, pay it back to their bank, down payments for houses, paid off debt, and which it's all about. Remember what I said at the beginning, it's about getting interest moving towards you rather than away from you. And so let's look at the players in the play. So now you've got earnings, you've got your bank, and what can you do with that money? Anything you want, right? So let's go back to the players in the play. You've got the saver, you've got the banker, and you've got the borrower, right? And so it's all about owning the system. So if you have a business or you own your earnings, you own the policies, you own part of the insurance company when you use mutual companies, you own your banking system, and then you can own all of this other stuff. So now you've got complete control and you've got a self-contained system, right? And so Nelson Nash in the great book, Become Your Own Banker, says everyone should have two businesses. The ones that give them a paycheck, right? So your business, your side hustle, your network marketing, direct sales, professional services business, but you also need to be in the banking business to finance all the other stuff that you want. Think about this. If you own the bank, would you put your money in Wells Fargo? Well, build your bank. So let's talk about the banking business. Would you own a business that did this? If you put in 10,000, do you get all your money out the first year when you start a business? What if you could put in 10 grand, you get back 6? Did you have a good year? Second year, you put in 10 and you got back out 8. You're getting better, right? What if year 3, you put in 10 and your business is looking better? Now it's breaking even. Then year 4, you 10, but from here on out, every 10,000 you put in, you can pull out more than 10,000, right? So how many times would you want this for your business model? Well, I just described to you the how a life insurance policy properly structured. That's how your cash would grow. Okay, a lot of people think, oh, how soon can I get my money? It takes 5, 6 years. No, it doesn't to build money up. It's just you don't have people that are structuring it correctly. So here's how you want to think about it. Insert your family there. We've got policies. We've got, this is the May clan there, right? And then for me, our business, tuition, big ticket items, and we use the money to fund our things that we want to do. Okay, it's a very active strategy. And so we call this another great book I love called The Money for Life, because this is the process. You got to get money, earn money, you got to bank it, you want to borrow it from your bank to do what? For major capital purchases and for opportunities. Spend the money, right, on what you need and want, and then repay your bank with both the principal and interest. Folks, that's the system right there. It's not about rates of return. It's about the fact that you finance everything you buy. All right. You're going to make your money off of what you do with the money. So we call that the velocity of money concept. And see, so let's start. I want to give you a visualization where the insurance goes in your strategy. So you've got to work and earn. We help people set up, we call it wealth coordination account. We'll just create a checking account called a wealth coordination account. We have our clients put 10 to 15% of income into this account to separate it from your bill pay money. Then we move some of that money, not every dime, through what I just showed you to create your banking system. Now you've got some money. Now, what can you do with that money? Anything you want. So now you buy rental properties. You can buy a franchise, or Candy Crush, I think, earned something crazy like $40 million, the person who invented that. You can buy commercial real estate. You take that cash, and what do? You run that back through your wealth coordination account, back through your policy. And so that is creating velocity. Money is not just designed to sit, money's got to move. And you want to create velocity and movement and multiple uses of your money. So this is a brief intro of the strategy. So ask yourself, are you interested in starting your own private family banking system? That's not what I want to cover. This is example. There we go. So what's your next step? You can check out our site at Practical Wealth Advisors. You can you definitely want to Become Your Own Banker or Money for Life by Jeffrey Reeves. We have an additional book. If you email me at kurtmay@gmail.com, I'll send it to you, or go here, preferably go here, and link it in, and we'll email you the book and implement your own banking system. So hopefully that was our brief intro lesson to the private reserve strategy. Thank you and have a great day.